Are you looking to buy a home with as little as 3.5% down and credit scores as low as 580? If so, then this video is for you. In fact, you can have credit scores as low as 500 as long as you have a 10% down payment and still qualify using an FHA loan. In this video, we're going to discuss the 2025 FHA loan requirements, answer some commonly asked questions around FHA, as well as show you how to do some basic FHA calculations when it comes to mortgage insurance and debt to income requirements. Now, I always like to start these videos up front with busting some of the myths out there when it comes to FHA. FHA is not just for first-time home buyers. It's for anyone who wants to purchase a home, regardless of their credit score or down payment. Now, in some cases, it wouldn't make sense to use an FHA loan, but in all reality, you could if you wanted. In fact, you can use FHA as many times as you want, but many times it gets associated with first-time home buyers because it allows a lower down payment and lower credit scores. But in all reality, it can be a great program for all borrowers. And the main reason is because it has the most flexible guidelines when it comes to qualifying for a loan. Not only do they allow those lower credit scores and those lower down payments, but they also allow a higher debt to income ratio, which means that you can have more debt and still qualify for more home using FHA than you can any other loan program out there. In addition to that, FHA has better interest rates than conventional loans. And because your mortgage payment is based off your interest rate, that means that using an FHA loan is often associated with a lower monthly payment when it comes to putting just 3.5% down. So with that, I want to take a little bit of time here and break down the different loan requirements when it comes to FHA to help you better understand them and also to see if it's the right loan program for you. Now, every time I do a video like this, I like to be very transparent. Just because you meet the qualifications that I'm talking about in this video doesn't necessarily mean you're going to be approved for an FHA loan. And the reason for that is because lenders have overlays on their programs. One lender might do it specifically like FHA allows. They might do it with credit scores as low as 580 with a 3.5% down payment, or with credit scores as low as 500 if you have a 10% down payment. But at the same time, another lender might not do that. They might want you to have a 640 credit score in order to do certain things. So just be sure when you're going through the pre-approval process, you're working with a lender that understands FHA, that they do a lot of them, and also one where they don't have a lot of overlays on their programs. So with that, I want to start with the most important feature when it comes to FHA, and probably the most well known. They allow you to buy a home with a credit score as low as 500 if you have at least a 10% down payment. Now, most people, when they buy an FHA loan, are only putting the minimum down, which is 3.5%. And if you're putting just the minimum down, which is 3.5%, then it's going to require you to have at least a 580 credit score. And there's really no if, and, or buts about it. If you have less than a 580, you're going to have at least 10% down. So a 500, a 579, still a 10% down payment. A 580, a 750, and 800 credit score, you only need 3.5% down, which means if you're buying a $100,000 house, you just need $3,500 for the down payment. A $200,000 home, $7,000. A $300,000 home, $10,500. And you can see here on the screen the additional down payments going up from there. But one thing to keep in mind about that is that doesn't include closing costs. Many times when you're buying a home, you're going to have closing costs on top of the down payment. Now, sometimes you might be able to get the seller to credit that amount, or in some cases, maybe you're getting a gift from a parent or someone to cover that amount. But either way, you need to understand that the down payment is just the down payment on the home, and that doesn't include any additional fees for closing costs. So there's a really good chance that not only are you going to need that 3.5% for a down payment, you're also going to probably need another 1 to 2% in many cases to cover closing costs. Now, something really important to note about that, closing costs are going to vary by state. They're going to vary by lender. They're going to vary by interest rate. Sometimes you can be buying down the rate. Sometimes you could be doing different things that cost more money. So it's really important to make sure you're working with a lender that can explain all of this to you, that they're not just throwing numbers at you and telling you this what it is, that they're giving you options so that you can make a decision on which direction you want to go with the loan. Now, from there, I want to talk about mortgage insurance, because mortgage insurance and FHA are often looked at as really bad things. People say you shouldn't buy a house using an FHA loan because not only does it have monthly mortgage insurance, it also has upfront mortgage insurance. And that's what I want to talk about right after you hit the thumbs up if you find any value in this video at all. And at the same time, if you want to stay updated on everything FHA, first-time homebuyer related, do me a favor and subscribe to the channel. Now, before we dive into the differences with FHA and other loan programs, it's important to understand what mortgage insurance is. Mortgage insurance is there to protect the lender in case you default on the loan. Because you're putting less than 20% down and you're buying that home, it requires mortgage insurance. In fact, almost every loan program out there requires mortgage insurance when you're putting less than 20% down. And FHA is one of those programs. Now, with that said, typically speaking, when you gain at least 20% equity in a property with a conventional loan, that mortgage insurance will fall off. Well, with FHA, it's different. Mortgage insurance stays on your loan for the life of the loan. So as long as you have an FHA loan, you're going to have mortgage insurance on that loan. And that's one of the negatives that people have with FHA, because you can get 20-25% equity in your property, and unless you sell that property or refinance out of that loan, you're going to have the mortgage insurance on that loan. Unless you put at least 10% down when you buy that property. So if you're one of those people that are putting 10% down using an FHA loan, that mortgage insurance will fall off, but it won't fall off until after year 11. So you can have the equity in the property, you can have all of those things, but that mortgage insurance is going to be on that loan until after the 11th year. Now, at the same time, if you're only putting 3.5% down, which is the majority of people using FHA, you're going to have mortgage insurance on that loan for the life of the loan. And in addition to that, you're also going to have something called upfront mortgage insurance, which is required on every single FHA loan, regardless of how much money you put down. Whether you put 3.5% down, 5% down, 10% down, 20, or even 50% down, you're going to have this upfront mortgage insurance, which is 1.75% of the base loan amount. And you might be saying, well, Jeb, what is the base loan amount? How do you calculate this? Well, let's go through it. Let's say you're buying a $500,000 home and you're doing the minimum down payment, 3.5% down. Well, that means your down payment is going to be $17,500. Well, you take that $17,500 from $500,000, which is going to give you a base loan amount of $482,500. Well, in order to calculate the upfront mortgage insurance, you multiply that by 1.75%, which in the case of this loan is $8,444, which is then added back to your base loan amount, which means you're going to finance $490,943, which essentially means about half of that 3.5% down payment is getting eaten up by that mortgage insurance, which means you're losing some of your equity to start. Now, you can look at this as a bad thing and say, I'm not going to use an FHA loan because they're doing that, or you can look at it as I do. It's the cost of doing business. If you're waiting to save enough money so that you don't have to use FHA, then how long is that going to take you? What is the opportunity cost on that? Because FHA is allowing you to purchase a home now with as little as 3.5% down versus waiting until you have that additional money. And here's the thing, there's really no way around it. So if you want to use an FHA loan, not only do you have to be comfortable with the monthly mortgage insurance, you also have to be comfortable with that upfront mortgage insurance. Now, with that, one of the questions that often comes up is, can I get rid of this mortgage insurance by refinancing? And I mentioned it a moment ago, and the answer is yes. You can refinance out of an FHA loan at any point into a conventional loan, assuming you meet the qualifications and assuming you have enough equity in your property. You can get rid of that mortgage insurance altogether. So in many cases, the mortgage insurance on an FHA loan is actually less than that of a conventional loan. So if you're comparing an FHA loan and a conventional loan, make sure your lender is giving you both options, not telling you which one you should go with. Hey, don't go with FHA because it's bad. Let you decide. Let you make the decision. See everything on paper, and then ultimately you make a decision. Now, normally I mentioned this earlier in the video, but this video should be considered for novelty purposes more so than anything else. Don't run off and say that you're qualified just because you meet the basic requirements that we've talked about in today's video. You're probably not qualified. In fact, you need to speak to a lender, show them, all of your documentation, your pay stubs, your tax returns, let them run your credit, all of that stuff to make sure you meet the guidelines. Don't just run with what I'm saying today and think that you're good to go, because that will happen. Some people will watch this video and say, hey, I meet all of those requirements, I'm good to purchase a house, and go out there and try to buy a house, and they end up not qualifying. So before you do that, just make sure you talk to a lender, go through the pre-approval process, let them run your credit, let them look at your tax returns, your pay stubs, all of that stuff, and tell you exactly how much home you can afford. Now, if you're watching this, you don't know where to start, you can actually work with my team and I by going to that link in the description of this video. In fact, it's a really, really good place to start, especially if you want a free and really a stress-free process. So if you're considering buying a house, make sure you start there. Now, the next thing I want to talk about, and also one of the most misunderstood things about FHA, is debt-to-income ratio. What is debt-to-income ratio? Debt-to-income ratio is essentially how much monthly debt you have versus how much income you bring in. And this calculation is used to determine how much home you can qualify, because lenders have a limit. They don't want you to have more than a certain amount of debt versus your income, because otherwise it looks like all of your income is going towards your debt. You can't afford a house, so on and so forth. So what I want to do is not only tell you how this works, but also walk you through a calculation so that you fully understand it. So let's start by saying that you make $100,000 per year. Well, the lender is going to take your $100,000 per year and they're going to divide it by 12 because there's 12 months in a year. They're trying to figure out how much income you make per month. So in the case of $100,000, that breaks down to $8,333 per month. So that's the number that they're going to use. Now you might be watching this going, well, Jeb, I have taxes taken out. I have money going here and there to my 401k. The lender doesn't care. They're going to use your gross monthly income before any taxes come out. And the reason they do this is because people have different calculations. Some people have money going to a 401k. Some people have money going to a deferred comp. So in order to keep it equal and easy to calculate, they use the gross monthly income. So just take your W-2 salary, assuming it's consistent, and divide it by 12. So in this case, we're using $8,333. Well, when it comes to debt to income ratio, there's something called a front end ratio and a back end ratio. The front end ratio is just your housing expenses. It's your principal and interest, your taxes, your insurance, your HOA, anything that's associated with the payment on that house. And in the case of FHA, they don't allow your front end ratio to exceed 47%, which means in the case of a $100,000 salary, your front end ratio cannot exceed $3,917 per month. So as long as your house payment that you're trying to buy falls within that $3,917, you qualify on the front end ratio. But here's the thing, there's also a back end ratio. The back end ratio is your front end ratio plus all of your monthly debt. Your car payment, your credit cards, your installment loans, the furniture that you have at Lender's Furniture or wherever it is. All of those monthly fees, your student loans, all of that stuff is added into your back end ratios. So let's say, for example, you have a $500 car payment, you have a $100 credit card, you have $100 worth of student loans. That's $700. Well, FHA doesn't allow more than a 57% on the back end ratio, which means your back end ratio cannot exceed $4,749. So in the example of a $100,000 salary, your house payment can't exceed $3,917, and you really can't have more than about $800 in monthly debt in order to qualify for that loan. Now that's assuming you're pushing the max on the front and the back end ratio. Now you can come in with a lower housing payment and have more money in debt and still qualify. And that's why it's really, really important, instead of doing these calculations on your own, to make sure you're talking to a lender that can walk you through this process. As I mentioned earlier, you can get in touch with us by using that link below. Now, the next qualification I want to talk about when it comes to FHA is that the home has to be a primary home, which means you have to live in that property full time. It cannot be an investment property to start. Now, it can be an investment property at some point in the future, maybe after you live in it for at least a year, then you can turn it into an investment property. But as far as purchasing that home initially, it has to be a home that you're going to live in, and it has to make sense to the lender based on that information. So if you own another home and you're saying you're buying this home as your primary residence, that has to make sense. Now, with that said, one of the really, really cool things about FHA is that they also allow you to buy multiple units with an FHA loan, as long as you're living in one of those units. But when it comes to FHA in 3 to 4 units, which is what a lot of people want to do, right? People want to buy multiple units and use the income of those units to help offset the mortgage payment. In fact, it's a really, really good way to start your real estate journey if you can do it. But here's the caveat, and what most people don't understand when it comes to buying 3 and 4 units. 1 and 2 units are exactly like we've discussed. 3 and 4 units are a little bit different because of how the lender calculates whether or not that property makes sense. They have something called a self-sufficiency test, where they take the rents of the other 3 units that you're not going to live in, and they take 75% of those rents. So let's say, for example, you're buying a property and each unit would rent for $1,000. Well, they're actually going to use 75% of those rents, which in this case is $2,250. And in order to pass the self-sufficiency test, that $2,250 has to be equal or exceed the monthly mortgage payment associated with that property in order for it to qualify only using the minimal down payment. Now, it can still qualify, but it might require you to put more money down. Now, in states like California and New York and really high cost areas where real estate's really, really expensive, it's very, very difficult to get one of these properties to pass the self-sufficiency test. Now, in lower cost areas where you can buy units for $200,000, $300,000, $400,000, in many cases those states will work. But if you're in a place with really, really expensive real estate, it's very difficult to buy that piece of property only using the minimal down payment. At the same time, there is an additional requirement when it comes to buying real estate using FHA. If you're buying a single family home, it doesn't really matter. As long as you don't have a bunch of health and safety issues with that property, meaning peeling paint, you have, working furnace, working appliances, that sort of thing. There's not really any safety issues with the property, then it should qualify no problem. But FHA is a little bit different when it comes to condominiums. Condos actually have to be approved with FHA. In fact, there's a website that you can go to where you can check to see if a property is FHA approved. And what I'll tell you, unfortunately, is most properties nationwide are not FHA approved. Now, if you're in an area that has a lot of condos, then chances are some are going to be, some aren't going to be. And you might be asking, well, what makes them approved? They have to pass certain requirements with FHA, with the Federal Housing Administration, when it comes to finances, how much money they have in the bank, just different things in order to meet those requirements. And really, this is something that your real estate agent should guide you on once you're approved and start working through the process, because they can tell you which complexes are approved, which aren't approved. And in some cases, you can actually get a property approved that's not on the approved list, but it's really going to depend on the property and the area and whether or not it meets the requirements. One of the additional requirements is that FHA has loan limits depending on where you're located in the United States. They have low cost area limits and they also have high cost area limits. I'm located here in the state of California, which means I'm in a high cost area. So our limits are higher, which means that we can actually buy more property, finance a higher loan amount using FHA than you can in a low cost area. Now, if you're watching this going, okay, what are the loan limits? What areas? I actually put a link in the description of this video where you can check your area to see if you're in a high cost or low cost area. And you can also see the loan limits. Now, one of the cool things is depending on whether you're buying 1 unit, 2 unit, 3 units, 4 units, it actually goes up. So if you're buying more doors, say a 2 unit or a 3 unit, you're actually going to be able to finance more in the low cost and the high cost areas. In fact, I put those loan limits in the description of this video so that you know exactly what the max is when it comes to qualifying for an FHA loan. Now, this requirement I'm going to talk about is pretty consistent whether you're using conventional or VA or FHA or what have you, and that's that you need to have at least 2-year history of employment. And along with that, you need to have steady income at that job. Now, this is really misunderstood with a lot of people because people change jobs, they change careers, they get promoted, they do different things, and they go, well, I don't really qualify now because I don't have consistent employment with that employer. No, you can change employers as long as you're in the same line of work, kind of doing the same thing. If you were in sales and now you're at a different company and you're doing sales, that's consistent. But what you don't want to do is be working for someone as a W-2 wage earner, for example, and then all of a sudden quit and become self-employed. That is frowned upon because you don't have a history of that self-employment. You want 2 years either being self-employed, 2 years being a wage earner, whatever it is, you want it to be consistent. And you also ideally want your income consistent as well. It can go up annually. In fact, that's a good thing. But what you don't want to see is somebody go from a $50,000 income a year to $150,000 income a year. Yeah, that's really good for you as the person that got that. But the lender, it's very difficult for them to quantify that, right? They want consistency. And with that, there's no minimum on how much income you need to make or a limit on how much you can make. You can make $5 million a year and use an FHA loan if you want. And you can also make $50,000 a year and use an FHA loan. But with that, you need a history of it, like I mentioned earlier. Now with that, there can be a little wiggle room here and there. And that's why it's really, really important that you're having this conversation with a lender sooner than later, especially if you have any changes in income, changes in employment, changes in any of that stuff. The sooner you talk to a lender, the sooner it can be addressed and you can determine whether or not you're in a position to qualify or you need additional time. Now, at the same time, you can be self-employed and still qualify for an FHA loan. The requirements are just a little bit different. You have to provide your full tax returns. You have to provide additional documentation versus someone who's a wage earner. And that's actually what I want to talk about right now. So if you're someone looking to go through the pre-approval process, keep in mind that you're going to have 2 years of W-2s. If you're self-employed, you're going to need full tax returns. You're also going to need a couple of months of bank statements to show where the down payment is coming from. If you have additional assets, it's always important to show those. So if you have a 401k, an IRA, if you have multiple checking, multiple savings, you really want a 2-month history of all of those accounts. In addition to that, they probably want a copy of your driver's license just to make sure you are who you say you are, along with filling out a loan application. And this process shouldn't cost you any money at all. And once they have all of this information, they're going to run your credit and they're going to calculate your debt to income ratio like we talked earlier. And from there, they should be able to determine exactly how much home you can afford. So do me a favor, if you found this video helpful, like and subscribe and actually comment below with your biggest takeaway. And if you would like my team to help guide you through that process, do me a favor and click that link below.